Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a mixed day on Wall Street. Tech stocks were under pressure, weighing on the S&P 500 and the Nasdaq. We've got the top takeaways from the trading day. Plus, President Trump looking to make big changes in the housing market, calling on Congress to codify a ban on large investors buying single-family homes. And the biggest tech event of the year, CES, is wrapping up on Friday. We're going to zone in on some of the biggest takeaways from that conference. Well, stocks pulling back from record territory here with the trading day takeaways. Got Yahoo Finance's Jared Blikre. Jared.
Thank you. We got to talk about some small records that would be in the small cap realm, and specifically the Russell 2000. So let's take a look at the chart for today. You're going to see it's from the lower left to the upper right, although it kind of went sideways most of the afternoon, but I think investors will take that. I do want to show a 5-year chart because we have been trading sideways almost this entire time, basically since the pandemic, and only recently have we broken free. And as I've said many times, when we've broken to new highs before, we have been met with some pretty steep declines here. So there have been a lot of fake outs, but I hear analyst after analyst saying, well, the setup is finally favorable for small caps. We've seen this movie before, but it does look a bit better than it has in the past. Also want to point out another record, which is in the Dow Transports. This is going to be a 5-year chart too, and you can see it has also been in a big trading range. What I like about the Dow Transports is that we've seen record highs with the Dow Industrials as well, and this just speaks as to Dow theory. That is, when you have the Dow Industrials, the companies making this stuff, in line with the companies transporting this stuff, well, that is just more bullishness. And so that's kind of a confirmation signal that what we are seeing is true strength. And so that speaks as to the general equities picture here, not necessarily small caps, that's in a world of its own, but there is just this bullish tide that we've been looking at, Josh.
Some might be wondering, Jared,
yes,
what does recent strength suggest about the rest of the year? What do you say?
We got to look at the January trifecta, and so this is all about the work of Stock Traders Almanac. Jeff Hirsch, he is a friend of Stocks in Translation. I've had him on the podcast many times. So I'm going to go to the S&P 500. I'm going to show you the first 5 days, and here we see it is up 1.11%. When the first 5 days is up, that tends to mean that the rest of the year is going to be up as well. So this is pointing to a positive 2026. Now, I said trifecta there, so there are 3 different indicators. The first one is already history. That's the Santa Claus rally indicator. That ended on January 5th. That's the last 5 trading days of the old year, plus the first 2 of the new ones. By the way, that was negative. However, I would point out that last year we had a negative Santa Claus rally and a positive first 5 days, and we also, the third one in the January trifecta is what January, the entire month, does. We won't know that until the end of January. But so far, it looks like we're tracking last year, and we know that last year was a bullish year, and when the first 5 days are positive, I think there are gains of 83% of the time, and I don't remember the exact percentage, something around 15% gains. Mm-hmm. That would be incredible to have double-digit returns for 4 years in a row. Might be getting a little ahead of ourselves because we're only 5 days in, but nevertheless, that's what the stats are saying.
Any warning signs on the Jared Blikre radar right now?
Yes. Speaking of Stocks in Translation, just had Todd Sonnen of Strategas ETF Research. I call him the ETF whisperer. And this guy loves ETFs. He does a lot of innovative research. And what he shared with us on the show, and the episode just dropped today, is that if you take all these leverage long products, and there's a lot of them now, and you add up all the assets under management, and then you divide it by all the short, the inverse ETF assets, right now you're getting a ratio of 13-to-1, and that is very skewed to the bullish side. The last time we were looking like this was about 1 year ago. And so this kind of set up that big decline that we saw. Now that was exacerbated by Liberation Day, so it wasn't predicting Liberation Day and a 20% decline, but it was suggesting that things are getting a little frothy right now. What Todd was very careful to say, and I don't want to give it away, so let's just listen to what he was talking about.
The great part about ETFs is I can get little clues on how investors are behaving. One of those ways is through levered ETFs. Take the ratio of levered long funds to inverse ETFs, and that's a pretty good and kind of new sentiment barometer. So we're at a new high on that, as you mentioned, 13-to-1. It is not a sell signal, but more a situational awareness that, hey, people are very enthusiastic right now. If that is met with deterioration from market breadth, that's when you start to raise your guard and say, hey, well, are we going into some sort of environment like we saw from March to April last year?
Big caveat, so we have not seen the deterioration in market breadth, so this is just a yellow warning right now. It is something to look out for.
All right, thank you, buddy.
Thank you.
Appreciate it.
Good to be back.
Stick around. Much more Ask for a Trend still to come. Trump saying in a social media post he has taken steps to ban large institutional investors from buying more single-family homes and will be calling on Congress to codify it. Joining me now on what this could mean for the housing market, we've got Lance Lambert, CEO and co-founder at Resi Club. Lance, it is great to see you. So let's start right there, Lance. President Trump says, you know what we should do? We should ban big institutional investors from buying single-family homes. What do you think, Lance? You saw the post. Smart policy?
Well, I think the big thing is we don't exactly know what's going to happen here. So we don't know if they're just going to ban new investment from scatter site home buying. We don't know if this is actually going to be implemented. Is Congress going to pass it? Will it be challenged in court? Is it going to include build to rent? Is it just scatter site? We still have a lot of questions. But what we do know is that whatever happens, if they are to pass some type of institutional home buying ban, it would impact, the impact would vary a lot by market. And the reason being is that the institutional levels of home buying are vary significantly across the country. So nationally, the institutional investors that have 1,000 homes or more, they own around 0.5% of housing stock. If you take that threshold down to investors with at least 100 homes, then it's about 1%. But if you go across the country, there are many markets where it's closer to zero, but then you have places like Atlanta, where 4% of all single-family homes there are owned by institutional investors that own at least 1,000 homes. And within just single-family rentals in Atlanta, that figure jumps up to around 20-25%. So the impact will vary significantly across the country, whatever were to happen. If you did have a scenario where this is not just a ban on buying new acquisitions, but it's also a forced sell-off, then the impact would be greater because you would start to see some burst of new listings in some of these markets, in Atlanta, in a Charlotte, in an Austin, in a Tampa, in places like Jacksonville that have this higher concentration of institutional home ownership. As of right now, though, it's unclear if that's going to happen. If you read Trump's post really closely, he had said stopping them from buying more kind of insinuates additional purchases, not necessarily a forced sell-off. So there's still a lot of questions, but whatever does happen, it's going to vary a lot by market.
Lance, let me ask you, one question is placing your bet on whether you think, Lance, this actually goes from social media post to actual policy, Lance. I guess I'm trying to get at how seriously should we take this, in your opinion?
Yeah, when Trump announced his proposal for the 50-year mortgage, I polled 1,000 people within the next 24 hours, and it had a net favorability rating of 50 percentage points. So the vast majority of people were against the idea. And so as soon as Trump announced the 50-year mortgage, it was dead on arrival, right? Because that's how Trump does things. He likes to test them, see what the public thinks. And when you look at this proposal, I did the same poll, 1,000 people answered it, and it had a plus 50 percentage point net favorability rating. And it was really across political party. It's a very populist idea. A lot of people like it. So I don't know if it'll actually become law, but I don't think Trump's going to step away from this concept and the idea because it's going to get headlines and a lot of people like it.
Let me ask you this, Lance, and your timing is impeccable as always, my friend. We have a new post from the president. Right in your wheelhouse. I'll read it to you. Get your thoughts on this. He says, because I chose not to sell Fannie Mae and Freddie Mac in my first term, a truly great decision, and against the advice of the experts, it is now worth many times that amount, an absolute fortune, and has $200 billion in cash. Because of this, I'm instructing my representatives to buy $200 billion in mortgage bonds. He says this will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. It is one of my many steps in restoring affordability something the Biden administration absolutely destroyed. I'm reading this, your reaction in real time, Lance. What do you make of that post?
Yeah, so the big thing to know is that in the bond market, yields and prices work inversely. So when there's more demand for the bonds, more demand for mortgage-backed securities, the yields and rates go down. So when the Federal Reserve during the pandemic boom period is buying a bunch of mortgage-backed securities, that's increasing the demand for those securities and driving down the yields, driving down mortgage rates additionally. And what we have seen is that last year, at the end of last year, Fannie Mae, Freddie Mac, the government-sponsored enterprises, started keeping more and buying some more mortgage-backed securities. Now, in the grand scheme of the mortgage-backed securities market, it was around $100 billion. That's not too big. But if you go to this year, according to Bloomberg, they expect that the Fannie Mae, Freddie Mac is going to buy around $200 billion in mortgage-backed securities. So it's a bit of additional demand for the mortgage-backed securities. It's probably putting maybe a teeny tiny bit of additional downward pressure on mortgage rates. You have seen mortgage rates come down over the past 12 months, around 75 basis points. The average now is around like 6.1, 6.2. It was around 6.8, 6.9 12 months ago. That's come down a bit. And a lot of that drive down in mortgage rates is not necessarily been because of the drop in other yields and treasuries. It's been because the spread between mortgage rates and the 10-year treasury yield has compressed. It's been compressing. That spread got really big when the Fed stopped buying mortgage rates back, or buying mortgage-backed securities back in spring 2022. And slowly that spread has been coming down. There's been compression there, and that's helped to bring mortgage rates down a bit. So it's possible that some of these measures by Trump could put a little bit of additional downward pressure on mortgage rates. But still, the big thing to watch here is the overall economy. If we were to see unemployment rate tick up more than expected, if we were to see a greater softening there, that's the scenario that would see us have a more material drop in mortgage rates than is currently expected.
Lance, we always benefit from your great insight. Thanks as always for joining us.
Thank you for having me.
Stick around. Much more As for a Trend. That's still to come. Chinese officials are set to approve the purchase of Nvidia's H200 AI chips, according to a Bloomberg report. This comes a month after the Trump administration reversed a policy allowing the chip giant to conduct business with China. Patrick Moorhead, More Insights and Strategy founder, joined Yahoo Finance to discuss what this means for Nvidia's business, as well as his biggest takeaways from CES.
I've been pretty consistent with this whole Nvidia China analysis, which is until the cards get shipped and the checks are cashed, it's not a done deal, because anything can happen at the last minute. And that can happen, China authorities coming in and just saying no for the 10th time, or the US government saying no for the 27th time, and this push and this pull. And it's funny, we're talking about H200s now that are significantly higher performance than the previous debate, which was around a card called the H20, which was about 1/10 of the performance of the H200. I think what this does show is just how long the conflict, this disagreement has been going on for so long that an entire generation of cards has happened. That's how long this has been going on.
I mean, but that also implies that if Nvidia does end up shipping and booking this revenue, that it could be higher, right? Because if it's a new generation, I assume those chips are pricier.
Yeah, we're looking at about a $30 to $40 billion lift for Nvidia. And if you just do simple numbers, $300 billion in revenue would be 10% lift on that, which, by the way, $30 billion now is significantly higher as a percentage if you go back when the conflict fully started. So it is a relevant amount of business. This doesn't mean that China will be completely open, because that could be, a tremendous, probably $100 billion opportunity. A $50 billion opportunity long term for Nvidia if they let the floodgates open.
Yeah, it doesn't seem like, at least according to reports, that that's happening. And as you say, we'll see when it actually, if and when it actually happens. We'll wait for the actual booking of that revenue. So let's take a look at what we learned from CES. And for Nvidia itself, there was all this excitement around the actual shipping of Vera Rubin, which is its latest generation AI. As somebody who is really steeped in this stuff, put it in perspective without getting too wonky. Why is this such a big deal?
Well, it's such a big deal because it used to be that we would do new chips every 3 years and then every 2 years. And now it's every year. And not only is it one chip, it's 6 chips with a very complex rack system that it goes into, or a very large 2-ton refrigerator looking rack. And therefore, when complexity goes up, risk goes up. And it was such a big deal for him to say that it was shipping. And if you remember, there was a lot of consternation about the prior generation. How was it doing in the ramp? How was Blackwell doing? And I think what this did is it really eased some fears of investors that this next generation would ship. That means higher revenue and higher profit dollars for the company.
Well, I'm curious about the higher revenue piece because he also talked about higher efficiency, right? For potentially meaning lower cost per chip if you're getting more out of them. So why does that then result in higher revenue? Like, do clients have to buy fewer of these, or will it allow them to buy more?
In a normal world, that would be the case, that clients would buy less. Because Vera Rubin is a huge advance in cost per token. What's happening, though, is this unrelenting demand for the amount of tokens. They might be increasing efficiency by 10x, but demand is going up by 50x. And that's why NVIDIA revenues are going to go up so much this year for calendar 26.
All right, Pat, we got to leave Nvidia aside for a moment. Besides that, what was the most interesting thing to you that happened at CES?
Yeah, so I think it was all about robotics, and whether that was Qualcomm going all in robotics and even pulling some major customers in there like KUKA and Figure. I think robotics, we all talked about it being the next wave. And what I saw was absolute proof points in the ecosystem, all the way from China to the United States and everything in between, that we are closer to reality. I would say the second one would be the further digitization and automation inside of the car. Right? You saw companies like Synopsys. I would say third would be Intel giving investors confidence. You saw a big pop yesterday, confidence about their latest chip that is manufactured on the latest process. So that was a big deal for investors. But I also think it was another proof point on the comeback trail. Even AMD had some huge announcements showing a little bit about their next generation MI 500 and giving investors higher confidence that their latest and greatest racks that are much more competitive with Nvidia and will be deployed into OpenAI, just a higher level of confidence.
Pat, somebody earlier in the week pointed out to me that what used to be known as the Consumer Electronics Show and now is formally CES isn't really a consumer electronics show anymore, right? It's more enterprise, to your point, as you talked about all of those things. But there is still consumer stuff there. And that used to be mostly what we talked about, the cool gadgets that we were maybe eventually going to see in our lives. Did anything stand out to you on that front? I know there was a vacuum robot that can climb the stairs kind of thing. Anything there that you thought was particularly fun?
Yeah, I mean, as you would expect, it was all about consumer AI, right? And I think the most exciting and relevant breakthroughs were AI in healthcare. Scales you could get on that could determine deeper levels of vascular health. I thought that was a big deal. And yes, the home robot, the folding robot, I think that had been shown 60 years ago. which is a very crude version of a robot that did your laundry and did your dishes. But I think reality of generative AI and agentic AI actually make this a reality. I mean, I think we're 3 to 5 years from the reality of a home robot doing something more sophisticated than, let's say, a one shot, doing one thing and doing it really well. And the reason for that is quite simple. The safety challenge of a robot, a 1,000-pound robot doing something very risky in your home, but also even the amount of energy and batteries that are required to make these multi-purpose robots do something interesting and useful and very reliably.
Yeah, it is not an easy challenge. And I should have known that the healthcare stuff would stand out to you, because I know you're a guy's interested in that kind of stuff. Patrick Moorhead, thank you so much. It's good to see you.
Thanks for having me on. Bye, Julie.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wealth.